DigitalOcean stock recently went public. The ticker is DOCN. A lot of folks are wondering, should it be part of their investment journey, especially as the stock has rallied significantly in just the last few months. They're leveraging the infrastructure as a service, sort of cloud solutions for small and medium-sized businesses, growing fairly quickly. That said, I think the price is just a little too rich for my taste, and I think the risk reward is not very compelling. Let's go right in to understand what do they do and sort of the setup as we look at DigitalOcean. So as we look at it, let's understand, first of all, this stock, since it went public, is up about 100%. Now it's in the low 80s. Why is it up? And I'd say broadly because, one, they're tapping into this large addressable market, this large and rapidly growing market opportunity. This is the Public Cloud Services Spending Guide for what's effectively estimated over the next few years for small and medium-sized businesses, effectively going from $44 billion to $116 billion. And that's the sort of the market that they're targeting, saying, hey, this is going to be a high 20% growth rate market that we're looking for, either as infrastructure as a service or platform as a service. And that's the key aspect. So A, you're tapping into a big market, and B, this is the thing that breaks Wall Street models. When you see revenue growth start to accelerate, you go, oh, well, we were already at a high level of growth, 24%. Oh, but now we're 26, now we're 29, now we're 35. This type of growth inflection breaks Wall Street models, because then folks start saying, well, wait a second, could it be 40% next year? Could it be 50%? Like, how long does this growth rate accelerate? What's the duration? And that's the billion-dollar question you should be asking yourself as you look at DigitalOcean. And so seeing this inflection is ultimately what's driven, I'd argue, the stock price so much higher in so little time. Now, to take a step back to understand, what does DigitalOcean do? Let's read their mission statement, where they're saying DigitalOcean simplifies cloud computing so developers and businesses can spend more time creating software that changes the world, i.e. this is about enabling accessible cloud computing solutions for small and medium-sized businesses. This is about making it so easy that a small and medium-sized business can spend just a little bit of money and easily onboard to their cloud platform. It doesn't have to be a big migration cost. It's an easy setup, so that way you can quickly start scaling and focus on the business itself versus, let's say, making sure all your data is, correctly stored. And so to understand the heart of their business model, you need to understand that this is focusing on really, really small customers. They talk about their average revenue per user of around $47 a month, several 100,000 users, nearly 600,000 users, and that's grown from about 500,000 over the last 2 years. Now, as I'm looking at these key metrics, I'm looking at hundreds of thousands of users, relatively low cost per user, so low revenue per user, so you're not worried about some sort of concentration risk. Now, I'm also seeing this net dollar retention rate of around 100%. That's not super compelling. That's all right. I mean, that means your prior cohort of business effectively grew by 3%. Since then, that's improved a little bit, effectively saying the prior cohort of customers, when you factor in those that churned out and left, all in, that prior cohort spent 3% more than they previously did in the prior year. And you can also see this is another key metric that is worth following, is the capital expenditures as a percentage of revenue. That is a big figure, that 38%. This is not software as a service. This is infrastructure as a service. So they're going to be spending a lot more in terms of on capital expenditures. It is worth understanding, though, that given the fact that their revenue per user is so low, this business model is really driven off of, can you continue to find tens of thousands, hundreds of thousands of new customers each year, because you effectively have these two levers, new customers and how much these customers spend, for using this model. And it's a pay-to-play sort of model. And so, they talk about, we focus heavily on enabling a self-service, low-friction model that makes it easy for users to try, adopt, and use our products. Our sales and marketing expense was approximately 14, 12, and 11% of our revenue. That's a really low sales and marketing expense, and that reflects how they have a model that does make it really easy to onboard new clients. So this does reflect, yes, we have a solution that works really well with small and medium-sized businesses that are just trying to figure out how to get online. So this is what I'm looking at. I'd argue, though, the big challenge is that what happens when they grow up? What happens when your customers say, you know what, we are actually this hyperscale business and we're going to quickly need, 5 times the amount of compute. We're looking at just so much bigger size. And the challenge is they grow up and they end up going to the likes of AWS, or they end up going to a second or third tier cloud player like Google Cloud. And the challenge is you look at AWS, they're growing 35% year to date. You look at Google Cloud, they're growing 50% year to date. And the reality is these top tier players, which I argue are winning the customers that DigitalOcean, that the customers that churn from DigitalOcean, the ones that say, you know what, we either are A, going out of business, so therefore we're not going to use anyone, or B, we're growing up. And so we just need a premium name. We need a premium infrastructure. We're going to go with Google Cloud or AWS. That leads to the higher growth rates, the bigger scale that you see with these players. And I'd argue that is one of the biggest challenges that DigitalOcean faces, especially when the fact that they call out, yeah, we do compete with AWS, we do compete with Google Cloud, Microsoft Azure. And when you look at them, these bigger players are not only many, many multiples the size, they're also growing faster. So if you're bigger and growing faster, that means over time you can dedicate significantly more resources to addressing solutions, to creating, better solutions for your customers. And I'd argue that will put DigitalOcean in a tougher spot. And so that is sort of my hesitancy as I look at DigitalOcean, DOCN. Now let me talk about the valuation, sort of what's being baked in right now. First, do a quick plug though. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. I'm looking for potential multi-baggers, folks, the types of stocks that could potentially go up hundreds or even thousands of percent over time. So if you're interested in looking for those types of companies, please make a point of hitting that subscribe button, hit that thumbs up button. If you want to follow my personal journey where I'm trying to buy these potential multi-baggers for myself, go to unrivaledinvesting.com. First week of the month, I call out my full portfolio. By the end of the month, I call out a potential multi-bagger. Within the next few days, I'm going to call out this month's potential multi-bagger. More on that, a little bit later, but we also have an exclusive dedicated community, an exclusive Discord server where I'm interacting with the Unrivaled Nation on a daily basis. And so when I'm looking at DigitalOcean, what does this sort of remind me of, in all honesty? And I've actually done a few videos on companies where it's like, wait a second, this just doesn't strike me as right. And I did a video on Fastly, another effectively a platform company investing significant amounts of money in CapEx. A lot of folks were equating it to software as a service type margins, but I just was like, well, wait a second, you're investing significantly in CapEx. This was one of my earlier videos, so if you check it out, I apologize for the quality of the production, but it was around 92 bucks a share, and I was like, what, this valuation doesn't make sense. And so this is for all the folks that say, valuation doesn't matter. Here it is, Fastly down 50% since I was effectively calling out, like, wait a second, this really doesn't make sense. Same thing with C3.ai, where shortly after they IPO'd, I was like, wait a second, does this have potentially 80% downside? Once again, something down 50% since I called it out. And so how should we think about, DigitalOcean? DOCN is the ticker. Well, let's see what management is sort of guiding us to sort of understand the key components. And so you see, what they're guiding to for around revenue, guiding to around 420 million in revenue for this year. They're saying around 120 million diluted shares, so that's worthwhile to understand. It is worthwhile to understand, okay, yeah, you do have this juicy EBITDA margin, but the reality is you're also investing a lot in CapEx. And this is part of the reason why you have folks like Charlie Munger, Warren Buffett say, EBITDA is a baloney figure, because you always need to back out whatever you're spending on capital expenditures. So EBITDA less CapEx, and that gets to a much, much lower figure. So that's, I would need to think about that as I'm looking at my margins. And then also another key thing that I'm reflecting on as I'm looking at this business growth is the fact that their customer growth is growing at 9%. Now that's nice, but that's, like how much further growth can you get when you're already at 600,000 customers, small customers, with the risk that once you hit a certain ceiling, they might start migrating over to AWS or, Google Cloud. And so that's a concern, but you do see this nice ARPU increase, and that's what's driven this 35% revenue growth in the most recent quarter. So you see, this 9%, this 25%, those are the key components. Yes, it's very possible you have continued strong growth, 20 to 30% growth easily in the years ahead. So that is worth reflecting on as you consider these two components. So as I consider it, reflecting on these different, inputs, reflecting on what this could pencil out to, so we do know the 121 million shares outstanding. We see the share price. So that's nearly $10 billion market cap as we consider it. We see that the last 2 years they've grown closer to 25% annually. This year, they're effectively guiding to low 30s, so they are seeing that acceleration in their growth to low 30% growth rate, so around 420 million in revenue. And so I'm saying, you know what, maybe that's conservative. So let's do a full range of 30 to 40% revenue outlook for this year. What's the long-term margins? Keep in mind that EBITDA margin of 30%, that's not truly reflective of what their profits look like, because they're going to be reinvesting a lot in terms of capital expenditures that they have to in terms of their data centers, for maintenance as well, not just for growth, capex. So I'm saying long term their margins might be 15 to 25%. I'm sort of casting a wide range there. Slap on a 20% tax rate, and you're effectively looking at something that strikes me as super expensive. Now, let's say, beyond 2021, let's look out another 4 years of 25 to 40% growth. And I think that 40% growth, in all honesty, is very aggressive, especially given the fact that this year you're looking at 30%. The last 2 years were closer to 25. So you're really talking about a continued inflection in the business. Are they really going to be able to continue growing their customer account that fast when they already at 600,000 customers? Possible. It's possible. It's just challenging. Will they continue growing their ARPU when customers might say, well, wait a second, could I get a better solution with AWS? The challenge, I'd argue, that they face. And so the end multiple range, I'm saying 25 to 50 times 5 years from now, and effectively playing for upside of 70%, downside of negative 70. So I just don't see this as a compelling risk reward. This is a hypothetical framework. Of course, the stock price could go way higher, way lower. If you feel like I'm missing something, I'd definitely love to hear your thoughts, because a lot of people have clearly been bullish, bidding this up 100% in just a short few weeks. I'm wondering, like, wait a second, assuming 50 times 5 years from now, assuming a growth rate that's been faster than the last 3 years, I'm just not seeing it. Like, it strikes me as super tough to get here in terms of, a compelling risk reward. It seems like a lot of downside. I'm thinking 30%, downside in sort of my base case. So I think this is a clear example of valuation likely does matter, and the risk reward just doesn't strike me as super compelling. Now, some folks like to say, well, Daniel, don't you say most companies don't strike you as that compelling? Well, I actually just did a video where I was talking about how Dr. Michael Burry was buying CVS. I personally haven't bought CVS yet, but that is a company that effectively trades at a 10% free cash flow yield. And I was like, you know what? You can watch the video where I'm effectively saying, yeah, the risk reward on that, yes, it's not a hyper growth company, but the risk reward does strike me as pretty darn compelling. If you are going to think about a company that's going to, soon be in a position to return 10% equivalent to shareholders a year. That said, if you are interested in, the plays that I am calling out, go to unrivaledinvesting.com. Last month's potential multi-bagger, the month before, were both companies growing at 100% plus in revenue, but trade at a quarter of the valuation that you see with DigitalOcean, DOCN. And so I'm looking at this, I'm thinking, wait a second, I'm finding businesses that are profitable growing at multiples of what you're seeing with DigitalOcean, yet trade at a quarter of the valuation. And so that just doesn't really make a lot of sense to me. You can check those out at unrivaledinvesting.com. If this video has been helpful for you, thinking about the risk reward of DigitalOcean broadly, what's their value proposition, what's the big risk that they're facing. If this has been helpful for you, please make a point hitting that subscribe button, hit that thumbs up. Thanks so much for watching.